Hello everyone, today is Friday, October 30th, 2020. My name is Evan. Welcome back to our weekly stock market analysis video. If this is your first time catching these videos, welcome to our channel. Welcome to this video series. We break our analysis up into two parts. In part one, we're going to review everything that went on this week in markets, and it was a busy week, lots to talk about. We're going to look at performance, talk about sectors and internals and volatility, and really sort of pick apart everything that is interesting and stands out. And then in part two, we're going to jump into the charts, put everything into from part one into context, and try and make sense of everything and position ourselves for the weeks ahead. So hopefully that sounds good to you. Before we dive in, I do want to make an announcement that I am traveling next week. I'm totally pretty much off the grid. There will be no videos next week. It's going to be a very busy week in the market, I'm sure. So best of luck to everyone trading and making decisions. But I will not have any videos out. I think next Friday I should have our next market analysis video out. So that should be the next one to look out for. Tuesday video, Wednesday video, and very light on social media or not at all on Twitter and so forth. So do keep that in mind. Let's jump into this week's headlines, some of the top takeaways here. Markets accelerating lower. VIX breaking over 30, so resolving that 2-month range to the upside. And there's really no good hedges this week to the sell-off that we saw. I wanted to spend a little time talking about that a little bit later. So let's jump in, take a look at performance here. It's pretty bleak. 1 week numbers, you can see 6.5% to the downside this week across the board. There's basically broad-based selling in all of the major U.S. indices. ACWX, so international world stocks minus the United States, actually fared a little better this week, down 4.76%, but that's still not really a great place to be, but notable relative outperformance there. If we go to market internals, with a 5% down week or 6% down week across the board, you could expect that it's very hard for market internals to show any type of strength here. We saw almost 200 net new lows on the week. Remember, Friday numbers here aren't finalized, so I'm sure this is actually going to be a bigger number. We're going to see more new lows being made on Friday's session. And the AD line here, you can see almost 6,000 stocks across the board falling to the downside. And take a look at this last one here, percentage of S&P stocks holding above a 20 SMA. You can see that number's at 11%. So basically saying that we are, quite oversold here in the short term, and a bounce here is sort of likely, or it's pretty reasonable despite all of the damage that we saw. Now, this here is our broader sort of intermediate look here at the number of 52-week highs minus lows. This is, one of my favorite charts, one of the most important ones that I follow here that we look at in this video. And you can see that this new downtrend has started here. It's not severe yet. So notice that, kind of the slope that we saw about 20 days ago, 4 market weeks ago, was a little more aggressive than the current decline that we're seeing right now. That can obviously change. This is something I want to pay attention to, though. When we start to get more stocks making new 52-week lows, you have to be cautious. You need to pay respect to that. And so I am respecting that at this time. And I want to see how this continues to play out. So something to keep an eye on, but certainly the new development here this week with the number of 52-week lows picking up to the upside. Now, if we look at sector performance, there's really no place to hide out this week. Everything was red across the board. If you look here at this last column, best performing sectors on a relative basis was utilities, real estate, and materials. So about 3.5 to 4.25%. And if you were stuck in the worst sectors, you're looking at consumer discretionary, industrials, and technology, down basically 6.5% for those three. Now, if we look at some volatility here, I think this chart is pretty spectacular. This is going to be, one for sort of the record books if you want to just look at basically the exact inverse of what you want to see if you are bullish on a market, or maybe if you're hyper contrarian in the short term, maybe this gets you excited. But basically looking here at this blue line this week here, this is the VIX term structure. And, you know, basically a normal healthy VIX structure starts down here, and it just gets this little kind of slight gradual to the upside, and then it starts to flatten off as you get out to that 1 year mark. Well, if you look at what we got going on here, we've got an exact sort of inverted curve. It's called backwardation by its technical term. But what this is essentially saying is that there is a tremendous amount of fear priced in here in the very short term. And you can see that as you go out on this structure, uncertainty or looking at hedges or things like that, playing market moves, actually gets cheaper as you sort of go out the 3, 6, and 1 year duration. So this is pretty impressive here. It's obviously all tied to election and election outcome. Is it contested? How long do we know when there? Do we know quickly if there's a winner, if there's not, so on and so forth. But when I see this type of fear, I can't help but think that there is a lot of uncertainty being priced in. Nobody wants to take the risk going into next week, and that generally leads to opportunity when everyone is hedged to the gills on a known sort of unknown. And so I'll sort of leave it at that. But I think this is again just a very impressive look here at what volatility is currently telling us. Now, if we look at interest rates and credit here, you can see yields were up slightly on the week. The 30-year was down just a little bit. You also saw investment grade bonds, high yield bonds, both selling off this week as well. So kind of in line with markets. Nothing too notable here, although I will say, I am surprised we didn't get more of a rotation into bonds this week. Bonds really didn't offer you much of a hedge this week. And I think that's interesting. We'll talk a little bit more about that when we get into the charts. If we look at dollar and commodities here, you can see the dollar index was up on the week, a little over 1.25%, basically putting pressure on everything underneath it. You can see natural gas is still a standout, 5.25%. There's been a lot of strength in natural gas recently. It's been basing out. I do think it's starting to warrant some attention. It's a tricky instrument to trade, but natural gas, I think, is worth paying attention to. Crude oil got hammered this week. Agriculture, ETF, gold and silver, all down as well. If we look at the report card here, negative across the board is basically nothing to speak of that's exciting here. So it's an F. Volatility environment is horrible. Risk sectors did not perform. Did not hold up at all. Market breadth was not there. The only thing you could speak to is, again, some technical stretched oversold signals, but really it's not showing up here in the way we model this report card. So last but not least, the Merlin positioning here, despite all of the weakness we saw, it didn't actually get a whole lot of change in our allocation. We did take some stops, but really didn't even get stopped out of too many trades, which is interesting. Certainly took our lumps here with some of this volatility, but really didn't change the structure of how we're positioned here. So this is still the breakdown. We're still invested in this market. Again, this outlook, this system is looking out more so on the 2 to 3 month duration, not so much in the short term duration. So that's kind of how we're still looking with Merlin. So that's it. That's it for part one. We'll be back in just a moment with some charts. All right, we are back here. We've got TC 2000 open. We have our equity market grid displaying right now. The dashed white lines is price itself on all of these charts. And the multicolored dots there is a smart trend filter of ours. It's a custom price and volume-based indicator that measures trend and trend strength. So we're on a weekly time frame right now looking at these markets. And one thing I do want to point out right off the bat here is that we are finally seeing some weekly, which we would consider intermediate or I guess longer term, depends on your preference, intermediate to longer term pressure on our trends. So if we look here at the S&P 500, see this is back to neutral now. Price is below our smart trend filter. So that's notable. Same thing for the Nasdaq. This is the first time we've gotten a yellow print here. So a neutral, choppy, indecisive, right? That's what this basically means. Print here on the weekly chart since April, or I guess actually May 1st of this year. So that is notable. That's interesting that the damage, that the selling and the technical weakness we've experienced recently is finally starting to creep into these bigger time frames. Same thing for ACWX. Notice though, it hasn't quite happened yet for the Russell 2000. So all of that is notable here, that the longer term, for you trend followers, position traders, longer term swing traders, I think that's interesting. Again, we typically, the way we interpret our smart trend filters here is that we still defer to the prior signal, and all of them right now are still bullish. So we still give the benefit of the doubt to the buyers here on the longer term time frame, but it's certainly an early indication signal. Now, if we're going to do a daily chart here, we are red across the board. So we've got red trend, red signals, sell signals, all printed this week for the indices across the board here. Most of them occurring on Wednesday of this week is when we got the sell signal in the S&P. Same thing for the Nasdaq. ACWX was actually a little bit earlier, and the Russell didn't happen until Thursday. So those are sort of our marching orders. Those are our objective lens, our analysis, the framework to view these markets. We've got bearish in the short term, and we've got bullish to neutral in the longer term. Now, I want to sort of deviate a bit here on sort of the order of operations of how you could use our analysis, our framework, what we talk about every week if you tune in. The first sort of flag that appeared this week, or the first warning sign, was in fact the VIX. So let's actually jump to the VIX right now. We have been talking about this consolidation here as it has been taking place, essentially, 25 to 30, rinse and repeat. We've talked about how that trade, had continued to work until, of course, it doesn't. Until, of course, you get a meaningful resolve, and that actually happened on Monday. So Monday of this week is when you had a change of character, something that you could hang your hat on and objectively say the market's sort of changing here. The structure's changing, risk is opening up, when the VIX surged over 30 and it closed pretty strong up around 33 on the day. Now notice our trend filters at that point had not caught that move. The trend at this point was still yellow here if you were looking at this type of model. The next thing that happened from a price action perspective was that the Russell 2000 broke down. So on Tuesday of the week, so Monday you had your early warning sign on the VIX. Tuesday you had the Russell 2000 starting to break below this 159 level, which we had been talking about quite a bit. You got a first close below there. That was sort of your second warning sign here that this market's changing character. Tuesday, VIX broke out, IWM broke down, and then finally on basically Wednesday is when everything else kind of followed. And Wednesday you had the gap down and breakdown in the S&P 500, in the Nasdaq 100. Wednesday, everything else started to lose those technical levels, and at which point you started to get the sell signals also showing up here in the smart trend filter. So by Wednesday of this week, that's sort of been your third and final clue that, indeed this market has changed its demeanor here. And I'm speaking mostly to the shorter term traders that are very active and looking, at the month ahead of us, the couple of weeks ahead of us. So I think that was just kind of a good illustration there on some of the things we've been talking about, how they unfolded and how they sort of got you maybe defensive or positioned a little bit better here for what we were dealt. Now, if we go to just a general sort of price action analysis here on, say, the S&P 500, this is the roadmap we've been looking at. 3,400. We lost that again on Wednesday of this week. We saw this big violent gap down, and we basically closed, right around 3,270 or so. We closed near the low end of this week's range. We've got this big open gap ahead above us. We are oversold here on lots of traditional metrics, but we know that there's been a tremendous amount of technical damage, frankly, and that the S&P 500 is in the penalty box right now, and it can easily bounce. It could bounce for a few days, but it really needs to, fill this gap, get back over 3,400. I mean, those are the things it needs to do at this point to start repairing itself, to start getting back above a positive bullish trend, and to start just acting better. So until and if that happens, you have to be neutral. You have to be either pessimistic, so you're short selling this market, you're high cash, you're day trade, you're doing the types of things to mitigate risk, or you're just sidelined waiting for a better spot. Now, obviously, we have the election. We have this big unknown event that is undoubtedly going to be a catalyst. Maybe we're up 6% after elections. Maybe we're down another 6%. Who knows? We've got a big range that is being basically priced in for this event. So I wouldn't be surprised to see some fireworks next week. Who knows on the direction? But this chart can obviously morph pretty quickly. As it stands right now, it's oversold. It's technically broken. It's in a downtrend. Those are the facts about the S&P 500 market. A lot of the way we can start to interpret some of this price action. I haven't updated these charts quite yet, but basically in a lot of these markets now, we can start to reference off of the September lows as kind of gauging relative strength, right? So for instance, if you just look at some individual stocks even, or just the major ETFs, and you want to start seeing how they're holding up relative to the September lows. If we look at the IWM, for instance, it's actually quite a ways above its September lows. So, September low is down here. We're trading up here. So that's a bit of a positive. Look at something like XLU, September lows down here. We're way up here. So this is a good way using the September lows to sort of measure and map and show some relative strength or relative weakness amongst indices, stocks, and sectors. So that's sort of the read here on the S&P 500. Technically broken. It's oversold in the short term. And it's got this gap to fill, and it's got to get over 3,400 on the upside. And I would watch September lows here on the downside, 3,216. We almost got down to them. And it's notable that we did get an aggressive rebound here off of the lows on Friday. Again, that's very short term, but we did, we didn't close at the lows of the session. We didn't drive lower in the last 30 minutes of the day. We, in fact, actually popped higher there. So it'll be interesting to see how we kind of shape up next week on Monday and sort of follow up that action. If we go to the Russell 2000 here, again, you can see that it really depends on time frame here. But for instance, like we talked about, this is well off of the September lows, and it's not all that far off of 159. So 159 to us, this is still the good momentum kind of positive trend that the IWM would need to get back above and reclaim for it to start acting better. And you can see that, based on today's close, it's only 3.5%, almost 4% away from that level, much closer than some of the other markets out there. So again, we can, look at this kind of half full, half empty, depending on your lens here. But it is still technically broken. It has this gap down, which didn't get filled. We're below 159. We're below the August breakout level. So for all those reasons, this should still be approached from a negative lens here in the short term. And yes, it is still technically oversold. Last but not least, the Nasdaq 100. Remember, Nasdaq is something we talked about. This was trying to hold up last week. It was trying to act best. It was trying to show some relative strength, and we knew that this week would be a busy earnings week. We had basically all the influential mega caps reporting for this index, and the reactions from those numbers were negative. The market basically sold off nearly everything. Most of all the big companies. Google, I think, was really the only standout that got saved. It ended up closing up 3.8%, but basically Amazon down 5.5%, Apple down 5.6%, Facebook down 6.3%, and right down the list here, Twitter, another one, which obviously is in a different category than mega caps, down 21% though. So it was a pretty negative week there for technology, the initial reactions, and we broke back below 280. That was the level we were paying attention to. Remember, we talked about initially this tight range and how some vol expansion was due to happen. It seemed like the logical approach was to lift to the upside, but of course that didn't happen. We made this probe down, we tried to jump back in, and then we really just sort of rolled back over. So the Q's technically broken, downtrend, needs to get back over 280 to start acting better, and then yes, it is still oversold in the very short term. So that's the lay of the land here. That's everything in terms of major markets, VIX, and how everything unfolded, from vol breaking out first, the Russell rolling over second, and then everything else following sort of third. Now, if we go to some other major markets here, go to our credit grid, and we take a look here, we'll go to the daily chart, you can see that VIX is in a positive trend. This is starting back on the, let's see, the Wednesday, the 10/21. The VIX went bullish trend here, and it clearly has mattered, right? It didn't break out of the 30 range until Monday of this week, but it did go bullish trend on our model here earlier. So this is, kind of continuing to work. This is obviously what's, was the early signal here, and the market soon followed thereafter. So VIX is bullish trend. That's bad for stocks. If we look at TLT, you can see this is still negative to yellow here. And I think what's interesting this time around is you're not getting support rotation or basically any type of reprieve from bonds in this sell-off. Now, there's a few different ways you could read that. You could say, well, maybe that's ultimately, bullish for stocks, or, we're going to catch a bid in stocks because you're really not getting that money into treasuries. So, there's arguments to be made here, and that's a big debate that's totally separate and sidelined. But I think ultimately it's just interesting and unique that if you were trying to hide out in TLT to prevent further pain, on equity side, didn't do a whole lot. I mean, TLT was certainly didn't fall as much. In fact, did it even fall, or was it just flat on the week? Let's take a look here. Yeah, it was down just slightly here on the week, but you'd expect that this would be up 1%, 1.5%, maybe even 2% on a week where SPY is down 6.5%, and that just wasn't the case. So I think that's interesting and notable, and that trend there is still suffering. If we go to commodities next, you can see gold here back to printing a bearish reading, a sell signal, fresh sell signal on Thursday of this week. It was neutral for a while. It was trying to gather itself and trying to lift to the upside. And gold, again, is another place where you'd expect you might get some hedge this week in terms of avoiding some of the carnage in equity land, and you didn't really get it. Obviously, the dollar was higher, so putting some pressure there, but you couldn't hedge out or hang out in gold either this week, and that went to a sell signal. Same thing for silver. This produced a sell signal on Thursday as well. Oil got hit really hard this week. Sell signal produced fresh there on Tuesday of this week. So that is kind of everything in commodities here. If we look at sectors and we go down to a daily chart of sectors, you can see just about every sector now has a sell signal attributed to it. The only real standouts here is communication services in the second top quadrant here, and then also utilities. Utilities are still yellow and with a strong prior bullish trend. So you basically have two areas of the market that are holding up at this point. And, that's, I think, just speaks to the broad-based weakness in selling that we've seen. So to speak a little bit more about those two sectors is XLU. As if we go down to the daily chart here, we talked about, this big range. It broke out, it consolidated, tried to break out again, and now it's kind of coming back to the top end of this range here. It wasn't immune to selling, but it certainly was a better place to be. Utilities is still a place I'd be paying attention to because they clearly are showing some good relative strength here. and that continues to work. So see if we can put a higher low in here, get back over $63, and you could get a nice kind of regain momentum in this area of the market. The other sector I want to talk about here is actually semiconductors. I think semiconductors are at an interesting spot too. So there's a lot of red here recently. They've basically been sliding nonstop for the past 2.5 weeks. And they're down about 10% off of the all-time highs they made earlier this month. But notice, again, when we think about, playing that relative strength game from the September lows were down here. We're still holding up here. We're still trying to hold on to this September breakout area. And semiconductors actually look pretty interesting here on a relative basis. And, tech, broad-based tech is much weaker, but semiconductors specifically are a bit stronger. So I think that's worth noting as well. Utility, semiconductors, two areas of the market that I'd be paying attention to. So that's it. That's everything I had. It was a super busy week. We got another busy week probably on deck here next week. We have those weekly charts under pressure. We've got short-term trends, which are all kind of pointing down for equities. We are oversold in the short term, and we got this big catalyst on deck. So it's going to be a doozy of a week. And as a reminder, I am basically checking out next week, so I will not be around. No videos, no updates. So good luck out there for all you playing and actively managing risk. And we'll be back hopefully next Friday with some updates for you to check in on how everything basically fared. So if you like these videos, do subscribe to our YouTube channel. Keeps you up to date with all the latest that we're publishing, or follow us at thetraderisk.com. Hope everybody has a great weekend, great week ahead, and I'll see you back here in a week's time.